Indian Railway Finance Corporation or IRFC Limited is one of those rare PSUs that grab market attention for all the right reasons. Backed by sovereign guarantees, a tax-free status and a near-zero credit risk model, IRFC delivered a jaw-dropping 785% return since its IPO in January 2021 to a peak of 229.05 rupees in July 2024. That's a CAGR of 88.52% in just 3.5 years. But from its peak, the stock has now dropped over 36%, leaving many investors wondering what's happening and what went wrong. Welcome to Bottomline by Groww. I'm Radhika Bajaj. In this episode, we break down the full picture, from the surge and slide in IRFC's stock price to its leasing-led business model, the recent slowdown in disbursements, and the strategic shift towards diversification. We will also cover the risks it faces and the valuation pressure at a time when fundamentals are changing. Let's begin. First, let's take a look at the reasons for the stock correction. IRFC's rise was spectacular, but the rally did not last. So what is it that triggered this reversal? Simply, growth stalled. Revenue and profits have barely inched up in FY25. Revenue rose just 1.9% year-on-year, and profit after tax grew a meager 1.4% year-on-year. This is a sharp deceleration from previous years where growth comfortably exceeded double digits. The weak performance was predominantly on account of a slowdown in disbursements, the funds IRFC provides to the Indian Railways and other rail entities. The disbursement reached its peak of over 1 lakh crore rupees in FY21, driven by major coach, wagon and project financings, but it crashed to just 732 crore rupees in FY24. That means virtually no new assets are being financed. With fresh business drying up, IRFC's assets under management or AUM have plateaued, declining slightly to 4.60 lakh crore rupees in FY25 from 4.66 lakh crore rupees 2 years ago in FY23. So then, what is the root cause? Indian Railways financing comes from the Union Government and IRFC's extra budgetary resources or EBR. EBR is the annual capital allocation that the Ministry of Railways authorizes IRFC to raise from the market for lease financing. The Ministry of Railways has not issued EBR targets for the last 2 years, effectively halting IRFC's ability to raise market funds and deploy new leases. Why did this happen? The Railways' direct budgetary support from the government swelled to a record 2.40 lakh crore rupees in FY24, which was fully absorbed into capital expenditure. With sizable allocations fully covering planned investments, there was no need for additional market borrowings, effectively leaving IRFC without a mandate to deploy new financing. As such, resulting in stagnant growth and the recent stock price correction for IRFC. However, the company has a few strategies to overcome the risk. But before that, let's understand its business model. IRFC's business model has always been straightforward and highly efficient with 3 key operations. The first is the leasing operations. IRFC raises long-term debt from the market and finances the acquisitions of rolling stock like coaches, wagons and locomotives for Indian Railways. These are leased under a 30-year lease with a 5-year moratorium and 25 years of lease rentals. During the moratorium, IRFC capitalizes its finance costs into its AUM. From the 6th year, the ministry begins regular lease rental payments, and at the end of the 30-year term, IRFC transfers the assets to the ministry for a nominal amount. All costs, including interest and currency fluctuations, are passed on to the Ministry of Railways, along with a fixed spread of 35 to 40 basis points. This guarantees profitability while keeping credit risk at zero. IRFC also has lending operations. To reduce dependence on Indian Railways, IRFC lends directly to other rail-linked PSUs like RVNL, IRCON and RailTel for infrastructure and logistics projects. This helps diversify its exposure beyond the railways. And then there are the borrowing operations. To support its leasing and lending activities, IRFC borrows from a mix of funding sources, including taxable bonds, capital gains bonds, rupee term bank loans, commercial paper, external commercial borrowings, and allocations from the National Small Savings Fund. This is enabled by its AAA domestic ratings and sovereign backing to achieve competitive borrowing costs in the 7 to 7.5% range. So what's IRFC's 2.0 strategy? To overcome the EBR-related challenges mentioned earlier, IRFC has launched its IRFC 2.0 strategy, which is a plan to diversify, grow, and future-proof the business. First up, diversification into project finance. IRFC is now eyeing forward and backward-linked infrastructure projects such as dedicated freight corridors, logistics parks, high-speed rail corridors, and even renewable energy installations for the rail network. One such example would be that IRFC has approved a 5,000 crore rupee loan to NTPC to fund its infrastructure expansion as a forward linkage project, since part of the electricity generated will be consumed directly by the railway network. This partnership positions IRFC for future growth and potential collaborations in the energy sector. With an approach like this, IRFC plans to tap into a 2.5 lakh crore rupee pipeline of non-Ministry of Railway projects over the medium term. It also reduces 99% Ministry of Railways exposure. Secondly, the company is looking for refinance opportunities. IRFC has also started refinancing existing project debt, replacing older loans with fresh disbursements at higher spreads. These new disbursements add to AUM and improve margins. To support this, it has signed MOUs with RITES and IIFCL to access technical advisory and co-financing support, accelerating its entry into newer asset classes. Thirdly, it's looking at financing the national infrastructure pipeline. IRFC is positioning itself as a key financier for the national infrastructure pipeline and PM Gati Shakti projects. It's aiming to raise competitive capital and embed itself in India's infrastructure framework. Together, these initiatives could counter IRFC's traditional constraints and drive sustained growth over the next decade. But all these strategies are not without risks, and valuation too remains a concern. Let's talk about the execution risk. Less than 1% of AUM currently comes from non-railway projects. Scaling this up is going to take time. Then there's competition. By foraying into the energy segment, IRFC now competes with players like REC and PFC who offer similar lending rates. Winning business may require lower spreads, eroding margins. When we talk about lending outside the sovereign umbrella, it introduces potential defaults, forcing IRFC to set aside provisions and adopt stricter risk controls. This could erode profitability, a challenge the risk-free model previously never faced. Then there is the tax exemption risk. Moving away from core railway financing may also jeopardize IRFC's tax-free status, subjecting it to standard NBFC taxation and further reducing returns. In terms of valuation, despite the slowdown, IRFC still trades at a price-to-book multiple of 3.5 times, far above its peers like REC, which is at 1.3 times, and PFC, which stands at 1.2 times. This premium was justified when IRFC offered risk-free, tax-exempt profits backed by sovereign guarantees. But that moat is narrowing. With disbursements down, leasing paused, and diversification still at its early stages, the current valuation looks stretched. So what's the investor's takeaway? Simply put, IRFC's success depends on executing its 2.0 strategy well. So unless IRFC can profitably scale its new loan book while preserving asset quality, its premium valuation may not hold. That said, there is a silver lining. In March 2025, IRFC was granted the Navratna status, giving it greater autonomy to invest up to 1,000 crore rupees in individual projects without government approvals. This allows faster decision-making to expand operations, form joint ventures, and enter technology or marketing partnerships more efficiently. However, whether IRFC can rise again depends not just on government policy, but on its own ability to adapt execute, and evolve. What do you think of IRFC? Is it just another PSU, or does it have the potential to be much more? Leave your thoughts in the comments, and for more such insights, remember to subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.